Hey, welcome back to the Wealth Academy channel. In this video, I'm going to be talking about how your financial advisor is lying to you about the rates of returns that you're receiving on your accounts. And here's what I mean. Most financial professionals even think that your average rate of return is the rate of return at which your money actually grows. And they never educate you or never go into the details of how your average rate of return does not equal your real rate of return. And here's what I mean. This comes from our financial forecaster that we use for all of our clients to help them with retirement income strategies and protecting their money from market risk and even reducing taxes when possible. But today, what we're going to focus on is how over the last 10 years, the stock market has been on one of the greatest bull runs in stock market history. And the average rate of return over the last 10 years has actually been about 12.21%, which is pretty good, right? And just to show you guys how this works, I just started in the year 2014, and I used the actual rates of returns that the S&P 500 has earned. And I put in $100,000 just to show you guys how the $100,000 would actually grow. Now, the thing to consider and to note here, I'm not including any fees from within inside of the account, which fees absolutely do affect your performance. But nonetheless, this is simply just going to be talking about the growth of what your money would have looked like inside of the S&P 500 and the overall market as a whole, right? So first of all, let me just erase and take out this column. And what I want to show you guys here is just starting with $100,000. I want to see, what is the return in every year. This would be year one, year two, year three, year four, year five, year six, year seven. And the interesting thing here is once we finally get to the year 10, this is how your money would have actually grown, right? And what I did is I took that 12.21% number and put it over here. And put 112.21% because this will make the math really nice and easy to be able to multiply and get a compound interest calculator to show you what $100,000 would turn into over the course of 10 years, earning that 12.21% rate of return. And just to make sure I'm doing it right here, I want to double check my numbers. Handy dandy investor.gov compound interest calculator. If you guys have never used this before, pretty awesome tool. I got to there very quickly. We use this all the time. But if you did have 100,000 growing it for 10 years at a 12.21% rate of return, that would equal 316,457. Perfect. 316,458 because we rounded up. So this is what your money would look like if you actually earned a real rate of return on your money of 12.21%. You would be at 316,000 by the end of the 24 years. However, you're not. Your account is really at 285, which is a difference of what, about $30,000 or so? So you're a little bit off. And now here's a perfect actually this is a perfect demonstration and an analogy of what is happening. You see how at the end of 2021 here you'd have $231,000 and then the market goes down by 19%. So your 231 becomes 186, right? In the next year, 2023, you gained 24%. So you lost 19, you gained 24. And on that 24% return, you're back to 231. So you barely break even here from the point that you initially started at. And this gets us into the break even burden of retirement planning. And what that means, let's see if we can find a nice image here. Perfect. So the company doesn't necessarily matter, but this happens to come from something from North American. You guys can see, I just pulled it up on a quick Google search. But in any given year, when you lose 20%, the return to break even after 1 year would be a 25% rate of return, which if we go back here, you guys can see that's exactly what happens. You lose about 20%, you need to gain about 25% just to get back at where you started. Right now, if you lose 40%, like a lot of people did in 2008, you need a 66.7% rate of return to get back to your break even. And so that is where your average returns do not always equate to what your real returns or what your account actually looks like. And so to demonstrate that and just to show you guys, one step further, let's just to say if we were to earn a 10% rate of return, so we'll go 110 on your 110 $100,000. So this times this, and then let's multiply this times this. This will give us a compound interest calculator. Let me do this. Cool. This will give us a compound interest calculator that we can start to look at to show you more closely like what your actual rate of return really is. So 10% wouldn't be right. Let's see, 11%. Very, very close. So can you see how here your rate of return in the market is more closely like 11% to get you to 283,000 rather than 12.21. Now, the last 10 years, there was really only 2 years of down years. This 2025 was a very small year. But if we go back and we do the math, actually dating back all the way to the year 2000 to today, one of the crazy things I want you guys to see, I'm going to come over to this calculator and this page here because we're going to demonstrate it just slightly differently. Let's go to 2024 because then we had some good years. Your average rate of return since the year 2000 is more closely like 7.33%, right? And this is starting with $1 million. Let's keep all the numbers the same. Let's go back to 100,000. So over the last 25 years, now if you're not taking out any income, your balance would be about 400,000. However, and your average rate of return would be about 7.33, right? Let's calculate for if you did start with your $100,000, and let's say you did earn a 107.33% return. Remember, that's just the math that makes it really easy for me to do a compound interest calculator here for you. And then I'm going to show you this times this. And then we're going to put all this into a dollar format. And so hopefully those of you watching this are enjoying me doing some calculations and actually running the math. This is something that we talk about often. Our company loves to look at the math because people can lie, numbers don't, right? And so with that, what did I just do? So now I want to choose H16. Perfect. There we go. So what this is going to show us is this is how your retirement account would have looked like if you truly earned a 7.3% rate of return every year in retirement. You would have about $586,000, but in reality, you only have 400,000. Once again, this just paints the idea and the concept, the fact that average returns do not depict your real rates of returns. And so just to kind of figure out an idea of what this looks like, let's go down to 6%. We'll just even put 6.33%. You're less than 6.33. Let's say 5.33, very close. You're probably somewhere around 5.75. Very close to 5.75. So your real rate of return over the last 25 years has been more like a 5.71% real rate of return. Isn't that crazy? So your advisors, the market, what you're seeing in the news, everything is telling you 7, but your real rate of return when factoring in the break-even burden and the impact that market losses have on your portfolio has you at 5.71. And now with that, my channel, our company, we talk a lot about fixed index annuities as a safe place to grow and store your money, and your safe money that you don't want to lose. It's not meant to replace stocks or to be an equity replacement. It is a much better bond alternative, but it can come with higher rates of returns than bonds. And I think I've done a video. If I haven't, I should. But I'll do a video one day talking about how fixed index annuities have been shown and proven in white papers done by really smart economists to show how fixed index annuities are a better alternative than bonds. But nonetheless, for this video, we're going to keep it as is. And here's the thing, when you don't have any losses in your portfolio, your average rate of return and your real rate of return are the exact same number. And so actually, let me keep this growth number here, and I want to show you guys what I mean. So on this on this example here of a fixed index annuity, and these numbers are separate. So let me separate them just a little bit more. On these numbers of a fixed index annuity here, you can see that when the market goes down, you don't have any losses. When the market comes up, you get some of the growth, and that's the trade-off you're willing to make. You get some of the growth with none of the downside losses. And just to show you guys how these numbers are being factored, you're actually getting 70% of the growth of the S&P 500 with none of the downside market risk. And there's some indexed annuities that do that, but not all of them are directly based on the S&P 500. It just depends on what their indexes are. But nonetheless, this is for conceptual purposes, okay? So in this scenario, if you have $100,000 and you're growing it for 24 years and you earned 70% of whatever the S&P returned with none of the downside losses, you would be at about 684,000 when you started with your original 100,000. Your average rate of return would be about 8.25%. And now here's the cool thing. When I come in here and do the math, enter in this 8.25, the numbers should be the exact same by the end of this. And so as you can see here, when I run the numbers, the 8.25% comes fairly close. It's off by about 40,000. And if I come here, I've actually got to tweak this to about an 8% return. And you can see the numbers are almost identical. So when you don't have market risk exposure and your money is principally protected, you don't have to overcome those losses that you would if you did lose money because your money's in the market. However, the reason being the numbers are still just slightly off is because of the compound interest, right? And when you have interest compounding on each other every single month or every single year, that could add and kind of tweak with the average compared to the real interest rate, but it is going to be a lot closer than would be the average versus the real rate of return when you're taking losses, right? So with that, if you guys have questions about fixed index annuities, how they work, and how it might be able to tie in with helping you just protect and preserve more of your money, let us know. Reach out to us to help. We'll include a link down below, or you can simply go to our website at www.thewealthacademy.com. And that is Academy with a K. And we'll be more than willing to talk you through and to see if this is something that would make sense for part of your portfolio. With that, thank you guys for watching. Be sure to like, subscribe, and leave your comments and thoughts below. And I'll see you guys on the next video. Take care.